Hello there, I'm Will Stevens.
And I'm Shaun Robson.
And today we're here to talk about what individuals should be concerned about or thinking about as we look at the upcoming budget on October the 30th. Particularly today we're going to focus on those who are in retirement, who are perhaps secure in their own lifestyle and are looking at wealth preservation and the ability to pass on assets to future generations. So Shaun, over to you. What are the sorts of topics that these individuals are coming to us about at the moment?
Yeah, thank you, Will. I think individuals and clients in these circumstances and considering the upcoming budget are really focused on sort of three key areas. So if we look at the impact of potential changes to income tax, I think what was quite clear in the run-up to the election day, the Labour government had said that they would ring-fence taxes around workers, taken to incorporate income tax, national insurance and VAT. So they have been quite clear, even post election day, that they aren't going to increase rates of income tax. That's led us to look at what potentially they could change in terms of raising tax revenue. And one obvious contender there is the continuation of freezing allowances, particularly the personal allowance from an income tax perspective. That's been frozen since 2021-2022 tax year, when Rishi Sunak announced that it would be frozen until the 25-26 tax year at the current level of £12,570. That was subsequently extended by Jeremy Hunt out to the 2028 tax year at the same level. And it's effectively a taxation by stealth means, because compounding inflation over time, the value of that personal allowance continues to shrink to a point where there's been lots of headlines recently from various papers that even pension savers simply relying on the state pension could well be in a position in the next tax year or two where their state pension itself becomes taxable because it's outgrown with increases over and above the personal allowance. So that's a big area for clients in terms of considering potentially those freezing of allowances continuing into the future. Secondly, and probably the biggest area, as you mentioned, these individuals are now focused on perhaps they've got security in their own income for the rest of their lives, and they're now really considering future generations of their family and how they would like to potentially cascade their assets through the generations. So a big concern for lots of clients in this situation is the impact of inheritance tax on their estate when they pass away. Now, inheritance tax, relatively high as a taxation, sits at 40% on the estate over certain thresholds. Those thresholds, things like the nil rate band, have been frozen since the sort of 2009 period and haven't seen any increases since. And that's a concern for clients when they're considering, how do they mitigate the impact of IHT. Now, there are various allowances, reliefs, exemptions that exist, and there's been lots of speculation and rumours about what a Labour government might do at the budget on IHT, and it seems that they are focused more on these allowances and reliefs that may well be seen as loopholes that could potentially be changed going forward. That has then linked into pensions, and the fact that pensions sit outside of the estate from an inheritance tax perspective is seen to be quite a generous tax break for pension savers. So again, speculation around whether a Labour government might consider bringing pensions back into the inheritance tax mix as part of the taxable estate going forward.
I think the inheritance tax picture is probably worth mentioning, that rate at 40% on estates over £1 million, effectively, if you're passing a main residence down to your direct descendants, is quite a high rate. But those thresholds have been, as you say, frozen for a long period of time. So not necessarily thinking that those will come down, but certainly some of those areas around it could be closed off or tightened up. If that's the case, what should people be thinking about? What are you advising your clients to start thinking about?
I think the key thing when it comes to estate planning is the sooner you start, the better it is in terms of creating the better outcomes for you and your family. So it is a case of, if you haven't started planning, do so. Start thinking about the options that you have. There are lots of different ways of moving wealth across the generations, making sure that you're able to support the causes that you want to at the right time, making sure you retain as much access and control as you would like as part of that process. With the raft of options that are available, we would always recommend seeking advice in terms of making sure that as you transition that wealth over the years, any planning you do today doesn't act to your detriment in 10, 20, 30 years down the line.
You mentioned a trade-off there between control, potentially, and maybe ease or cost. Is it worth touching on what that looks like?
In terms of potential solutions, very straightforward solutions are direct gifts to the next generation, whether that's children and or grandchildren, and that really depends on the individuals and personal circumstances. But gifting is the most straightforward way of passing wealth across those generations. It's the most cost effective, it's the quickest, it's the easiest to administer. Beyond direct gifts, which again have their own risks attached, may want to consider looking at options that allow you to retain control, and that would consider things like trust planning. Trusts allow you to move money outside of your estate, put them into a trust structure where you can retain control as a trustee. That gives you control potentially over the timing of how that money is distributed in the future and to what level is distributed. And in an intervening period allows you to control how that money might be invested on behalf of the beneficiaries.
I think it's important to note that if you are gifting directly, you can gift as much as you like, provided you live for 7 years. There's no inheritance tax to pay on that. There's an ability to do smaller sums as well. Regular gifts out of surplus income is something we talk to clients about quite a lot. On that point, I guess that regular gifts out of excess surplus income, there's quite a lot that can be done for younger generations, not just children, but maybe grandchildren as well. And there are vehicles that money can go into for them in order to save for them as well. What sort of vehicles do we look at when we look at this intergenerational planning element?
It's a really good question, and it's not only worth considering the level of gifting that you're making to those generations, but also how they're then going to use those assets themselves and perhaps what their needs and requirements are. So making sure that continues to be tax efficient, not only once it's left your hands, but also in the hands of the beneficiary. So looking at things like junior ISAs, bare trusts, potentially pensions, future generations, is a great way of ensuring that once you've made that gift, that it continues to be tax efficient and can continue to grow on behalf of the beneficiary into the future.
Yeah, absolutely. Quite a lot to cover there. So thank you, Shaun, for your time. Thank you, everyone at home. Hopefully you found that useful. If you'd like to know more, please do get in contact with us.